Financial statements are composed of the statement of comprehensive income, statement of changes in equity, or as some call it, statement of equity without the words changes in. This is also known as capital statement. Statement of financial position or balance sheet, statement of cash flows, and notes to financial statements. Comprehensive income is the change in an entity's equity during a period resulting from transactions and other events other than changes resulting from transactions with its owner or owners. What are the transactions of a business entity with its owner being referred to here? Investments and withdrawals or drawings. In other words, comprehensive income is the change in an entity's equity during a period arising from transactions and other events except changes resulting from owners' investments and withdrawals. Now, recall another thing you learned before. Aside from owners' investments and drawings, what else affects or affect equity or capital? Revenues or income and expenses. Meaning to say, comprehensive income is the change in equity during a period arising from revenues earned and expenses incurred, including other income, gains, and losses. Comprehensive income is composed of components of profit or loss and components of other comprehensive income. The profit or loss mentioned here is the total income minus expenses, excluding the components of other comprehensive income. Stated in other words, this profit or loss is the net income or net loss, the last line or the bottom line in the traditional income statement. The term other comprehensive income is composed of income and expense items, including reclassification adjustments which are not required or allowed by Philippine financial reporting standards to be recognized in profit or loss. The elements of other comprehensive income include the following. These components of other comprehensive income are discussed separately in higher accounting subjects. For now, suffice it for you to come across them. The presentation of comprehensive income may be done in either of two ways. First, as two separate statements, namely income statement showing the components of profit or loss, and statement of comprehensive income starting with profit or loss as appearing in the income statement plus or minus the elements of other comprehensive income. Or second, as a single or combined statement of comprehensive income presenting both the components of profit or loss and the components of other comprehensive income. In this video series, I will be discussing the preparation of the income statement, the statement of changes in equity, statement of financial position, and notes to financial statements. The preparation of the statement of cash flows deserves a separate lecture series. When an entity is already in operation, meaning it has already started earning revenues or incurring expenses, the first financial statement that should be prepared is the income statement, followed by the statement of changes in equity, then by the statement of financial position. However, the income statement and the statement of financial position are difficult to complete without doing even partially the notes to financial statements. Therefore, one should start doing the notes to financial statements simultaneously with the income statement and statement of financial position. There are two forms of income statement, the functional form and the natural form. The functional form classifies expenses according to their function. That is, as to whether they are part of cost of sales, distribution cost, administrative expenses, or other activities. No wonder the functional form is also known as cost of sales method. In contrast, the natural form aggregates or groups expenses according to their nature and does not classify them among the various functions within an entity. Meaning, expenses are not classified as cost of sales, distribution cost, administrative expenses, and other activities. Rather, expenses of the same nature are grouped together. For example, all depreciation expenses, whether depreciation of office building or of store building or of office equipment or store equipment, are aggregated and shown as one item. An entity using the functional presentation is still required, however, to disclose additional information about the nature of expenses. That is done through the notes to financial statements. This is an example of a functional form income statement. Notice that the expenses are classified as to whether they are part of cost of sales, administrative expenses, distribution cost, finance cost. Students must memorize this. Net sales less cost of sales, or also known as cost of goods sold, equals gross profit or gross income. Add other income to arrive at the total income. Then, less expenses, classified into administrative expenses, distribution cost, and finance cost, and even other expenses, to arrive at the net income or net loss. Notice these three: administrative expenses, distribution cost or selling expenses, and finance cost are indented, meaning written further to the right and not aligned with these expenses, because each of these three is considered part of these expenses. That is why the amount of each of these three is written not on this second money column, but on this first money column. Only the total of these three is extended to the second money column. Hence, this 2,038,437 is the total expenses, which is the amount deducted from the total income in order to arrive at this amount of net income. Notice also that there is a column here for note number, which signifies that the computation of the amount written on the right side of a note number like this 5,584,200 on the right side of this note 1 is found in that note number in the notes to financial statements. That's why, if you remember, I mentioned a few minutes ago that the notes to financial statements should be done simultaneously with the income statement as well as with the statement of financial position. You cannot have the figures here with note number unless you compute for them first in the notes to financial statements. Of course, those amounts in the income statement, statement of changes in equity, and statement of financial position without any note number are arrived at by adding or deducting figures on the face of the financial statements, such as this total liabilities of 475,650, which is computed by adding current liabilities and non-current liabilities, or are simply forwarded from another main financial statement like this Esteban Capital in the statement of financial position amounting to 2,170,000, which actually came from the statement of changes in owner's equity. Or are just picked up from the adjusted trial balance or 10-column worksheet, such as this merchandise inventory end in the statement of financial position. And once more, please memorize this functional form income statement, just like how you were asked before to memorize this statement of changes in equity, and advised to be very familiar with the statement of financial position. By the way, the statement of financial position of a service concern business is very similar to that of a merchandising business. The difference lies in the fact that a merchandising business has the asset account merchandise inventory, which is not found in a service concern entity. You must also be familiar with the computation of the net sales. Sales or gross sales, less sales returns and allowances and sales discounts. And of course, the computation of the cost of sales or cost of goods sold. You must memorize this. There are many possible questions or problems which you can never answer with close notes unless you know this by heart. Anyway, just like almost everything else, memorizing this is not difficult and comes naturally when you understand what this is all about and the idea behind this. For that purpose, in the beginning of the next part of this lecture series, I will explain the essence of this note 2. Until then, thank you for watching.